So welcome to the second lesson of business accounting. So let us quickly go through what we learned last time, and then we'll get on to the second topic. So just a quick wrap up of what we did last week. So we started with the introduction. I hope everybody can see the board.
It's visible, sir.
Right. Okay. So we looked at, we had an introduction to what is business accounting, and then I also mentioned about the purpose of this subject module when it comes to the banking examination, and like what is the expectation, right? So what is expected from you as an exam candidate, and how do you apply this same when it comes to the business world, right? In your day-to-day operations, maybe in your office, or when you are evaluating a lending proposal. So whatever it may be, how you apply the knowledge that you gain from this subject module into your business environment. So we looked at what is business accounting is, and then we went on to look at what organizations are, or what does organizations mean, and what is the various types of entity there are. We may call it companies, entities, so many names are given, and what are the types of organizations, and how we can segregate these organizations, what are the criteria that you can apply in terms of control, in terms of size. There were so many criteria that we used. So all these gives us an understanding of how do we classify the business organization that we have, right? So it is very important to have this knowledge when you go further in this subject matter. So it is very important to know that the business organizations, because when you are evaluating a business or maybe a lending proposal, you need to know like what are the things do you need to look at. If it is a sole proprietorship, what you will look for. If it is a partnership, what you will look for. If it is a company, whether it is a limited company or unlimited company, whatever it may be, you need to know what is the structure and how it is governed. Then we also went on to look at the advantages, disadvantages, which I wanted you all to go through. Then we looked at the two types of environment that the companies operate. There was one environment which is known as the internal, which is specific to the organization, and there is one called the external, where you deal with external parties. There are so many interactions that you might have with externality. Say for example, if you are working in a bank, if you look at bank as an organization, it has to interact with the Central Bank of Sri Lanka, who is the regulator. So that is the external environment in which you have to operate with. So that is what basically we did last week. In addition to that, I have already also spoken about how a company structure happens. Let me give you a little brief on that also before we go on. So we look at a company or entity. Now this entity, let's say this is a company, not a sole proprietorship, not a partnership, right? So this company is built up by having capital. I introduced the term capital, right? So capital is the money that is required to set up this business, or maybe for its day-to-day operations. You might also have, later on we will learn the capital that you require for day-to-day operations will be known as working capital. The capital that is required for your day-to-day operations will be known as the working capital. But what we are looking at here is where the startup capital for a business or maybe for the long-term investments. So let's say there are 4 people, A, B, C, and D. According to the requirement, this company requires a capital of, let's say, 100 million. 100 million. And these 4 people have come forward to do the funding for same. They are going to do the funding. How they are going to do it? Let's say this person is going to give 40 million. This person is going to give 30 million. And 15 from this person. Right? Let's say this is 35. 75, 90, and 10 million from this person. Okay, 75, 90, 100. Right. Now, when they come and invest in this company, they become the, what do you call them? What do you call them? How do we call them?
Shareholders.
Shareholders. You need to speak out. Right? So they are called the shareholders. They become the owners and they are known as shareholders. Right? So now these people have given money to this company. What did they get in return? What did they get in return when you put money into a business?
Profit.
Sorry?
Profit.
Yeah, so that is at a later stage. Now what I am asking is, when you initially give money to this company, how do you certify that you have given money to this company?
Shares.
Yes. In return, all of these people get shares. Shares. So this company is established by shares, issuing shares. Let's say this company issues shares of 1 million each. Right? To simplify this example only, I am telling you 1 million each, shares of 1 million each. So how many shares are there? How many shares will be there? How many shares will this company have? Yes? We have 100 shares. Very simple. If one share is 1 million, then to make up 100 million, you need to have 100 shares. Very straightforward. Right. Now go to this. Now, if it is totally 100 shares, how much this person will have? 40 shares. Am I correct? 35 shares. 15 shares. And here 10 shares. Right? So this is what the document or evidence that they get in turn from the company that they are a shareholder. Now this is what they are going to give them ownership. Right? That document is very much valid. They can go and sell it to anybody else. If it is a tradable organization, then you can sell this to somebody else and you can go out of the ownership. Right? Now, if this is a company which is listed, we call it listed. Listed. Right? These are the additional information that we are discussing. So if you want to make notes, you can make your own notes, or you can write it in your slide presentations itself. Whatever that you want to take down, you can take down, right? So suppose if this is a listed company, what do you mean by listed company? Now this is a company which is listed in the Colombo Stock Exchange. Colombo Stock Exchange. Colombo Stock Exchange. CSE means Colombo Stock Exchange. So which means these 100 shares are now going to go into the Colombo Stock Exchange and they are going to get traded. Traded means people can buy and sell these shares. People can buy and sell these shares, right? So how it can happen is when any of these shareholders want to sell their shares, they will make a bid, right? They will say, I want to sell these shares. Now you know the price of one share is 1 million, right? That is the price that they have paid, but they may not want to sell it at 1 million. They might sell it at, let's say, 1.2 million. 1.2 million. So let's say this we want to sell this at 1.2 million, these 35 shares. Assuming that there is a new person named M wishes to buy this, right? Now what they will buy is again these 35 shares. Again these 35 shares. The moment it is sold, this person loses his ownership. His or her ownership. They go out of the ownership. So now it will be A, C, D and M. A, C, D and M. Still, the company's capital will not change. It will remain at 100 million. But now you should ask a question. What is that? The shares were purchased by this person by paying 1 million. Now he has sold it for 1.2 million. What happens to the balance 0.2 million that this person pays? And actually it is 1.2 million means 0.2 million into 35 shares. So which is how much? 7 million. Am I correct? So what happens to the additional 7 million that this person pays? That is a profit to this person. We call that profit generally as a capital gain. Capital gain. Okay. So this is like a small synopsis with regard to how the company's ownership can change. How the company's ownership can change. So any moment, any of these shareholders can sell their shares and somebody else will buy, maybe at a higher price or maybe at a lower price, depending on the requirement. We don't know. If it is sold at a higher price, this person will have a capital gain. If it was sold at a lower price, this person will have to absorb a capital loss. Capital loss. Okay. So this is like a small introduction to the company, how they operate, who are shareholders, how the ownership can change. And one person said that when they invest money, they get initially the shares, but why do they want to invest? To look at a proper return. So what is the return that they are going to get? What is the return?
Dividends.
What do you call it? Return is? I introduced this term. What is it?
Dividend.
Dividends.
Dividend. So they will get in return something called dividend. And from where you get this dividend? That is from the profits. So the company first has to earn profits, and when they earn profits, what they will do, part of the profits, they will distribute it to the shareholders to make them happy. Otherwise, they might want to have the money back, right? So the company has to earn profit, and once they earn, they will pay a portion of that as dividend. The remaining part will be retained in the company for future expansion. So what will happen? They will pay a dividend per share. per share they will pay a dividend. Let's say, since it is 1 million worth of share, let's say per share they will pay 10,000. I'm just taking hypothetical numbers. Per share they are paying 10,000. So this person will have 10,000 into 40. Why? He is holding 40 shares. This person is holding 35 shares. So 10,000 into 35. That is the amount that they are going to get as dividends. Okay. Are we clear on that? Because later on when I say dividend, when I say capital, you shouldn't be looking at me that something that we didn't learn, right? So there may be candidates who might already know these stuff. Since some of you might have already done A-levels or maybe any other exams, you might have known, but there could be people who might not know anything about it, right? So for the benefit of them only, we are going very slowly and detailed all these stuff. Any questions that you want to clarify? Okay, right. So let's get on with the second lesson now. I'm going to share the screen. The handout is already there in your portal. Right. So we are going to look at the second topic, which is on the framework for financial reporting and preparation of financial statements, right? So we are going to look at the framework applicable for the financial reporting and the preparation of financial statements. You all can see the screen, right? The presentation is visible?
Yes, sir.
Yes.
Right. Okay. So first of all, we are going to look at what is the need for a common framework. What is the need for a common framework? Now, you know, all the companies in this country, whether they are listed or maybe private companies or maybe a sole proprietorship, still they need to prepare accounts. Why do they need to prepare accounts? Why do they need to prepare accounts? Yes? Why do all these companies need to prepare accounts? Somebody should answer.
To evaluate the progress.
To evaluate the progress. Very good. So we can call it, in other words, to evaluate the performance. To evaluate the performance. So why now you all are following this course? How you will be evaluated at the end? By evaluating your performance at the examination by looking at the pass mark of yours or the score marks that you score in the examination. Now likewise, every company would like to evaluate their performance because they are running a business. And most of the businesses are profit oriented. We say profit oriented because their motive or target or objective is to make a profit. So in order to evaluate whether you have made a profit or how much of a profit you have made or whether you have ended up making a loss, so all these have to be evaluated. So in order to evaluate or calculate, you need to do accounting, right? So you need to know, you need to do accounting. So one of the primary objective of accounting is to let your stakeholders, now I am introducing another term here, from shareholders, now we are going into the term stakeholders, right? If you have the handout, please underline. It is a very important term. Now, who is a stakeholder? Can we have some examples? Who is a stake? Customers, yes, very good.
Owner.
Pardon?
Shareholders.
Shareholders, yes. Shareholders are also
Competitors.
stakeholders. Who else?
Producers.
Producers, right. So that is the manufacturers, right?
Competitors.
Competitors, yes, of course. There are a stakeholder, yes. Who
Government.
else? Now
Manage.
let's take the example of a bank. Let's take an example of the bank, right? I hope majority of you all are working in banks. So assuming that you all are bankers, now look at a bank and tell me who are the stakeholders of a bank. Who are the stakeholders of a bank? Now you should.
Government.
Depositors.
Depositors, very good. They are the very, very important stakeholder for you. Why? Because banks are running because of the customer deposits, right? Mostly banks have to be run using the customer's deposit because that is their banking business, accepting deposits. That is the fundamental, right? So one of the stakeholders will be your depositors. Who else? Who else?
Competitors.
Central bank.
Right, let's put down some of these on the board. Right. So let's look at, you are going to tell me one by one. So somebody said depositors. Right, okay, done. Second,
Competitors.
competitors, good. Competitors, because they are always looking at you, what you are doing, because they are the people who can easily copy what you are doing, isn't it? If you are trying to introduce a new product to the market, right? You are trying to bring in a new product, like very fascinating youth product, deposit product. What happens? Very soon you will see a similar product is there in the market. Some other bank will come with that. So competitor is one of them. Yes, good. Right, then
Central bank.
central bank, because they are the regulators. They are the regulators. They are the regulators. Right. Who else? Who else? You all have to-
Shareholders.
Shareholders, very important because they are the people who are owning your bank now. So shareholders, right. Who else?
Government.
Government, very good. Government.
Employees.
Employees, there you are. Employees, right. Who else? I
Customers.
think only 2 or 3 people talking. What about others? Who else?
So customers.
Customers, when you say customers, basically here they are, right? We put them into this, but you are missing another important category of customer. Who is that?
Lender.
Who is it?
Lenders.
The borrowers. The borrowers. People who come to you asking for loans, isn't it? People who come for loans asking you, give me a housing loan, you give me a personal loan, you give me a business loan. All those are borrowers. We call them borrowers. Who else? Somebody said another term. What is that? Who else? Somebody said lenders. Who are lenders? Now sometimes what will happen? The bank also might need money. The bank also might need money. So what do? They go to some other people to borrow. So those people become lenders to you. Say for example, you can have like Sri Lanka, mostly the Sri Lankan banks, they depend on IFC, International Finance Corporation, or maybe the ADB, which is the credit lines, right? So these are the people who do funding or lending to the banks. So the lenders are also very important. Who else? You can have suppliers, right? The banks. Most of the banks are run by. You have stationery in your banks. You have furnitures, computers. Some of you hire or rent out buildings from other people. So all those are suppliers. So you can have a huge list like this, right? In detail you can go. So who are these people now? They are all your stakeholders, right? So there is a clear difference between stakeholder and a shareholder. Shareholder is the owner. Then who is the stakeholder? Who is a stakeholder?
Interested parties about the
Very
business.
good, very good. So now we know all these examples. But who are these people? People who are interested in your organization. People who are interested in your organization. So they are always watching you. They are always watching you. So when they are watching, how can you go and reach them? How can you go and reach them? So you will try to reach them by producing financial information. Financial information, right? So the financial information becomes the vehicle that you use to reach out to your stakeholders. Okay? Is that clear to you all? The financial information will be the vehicle that you will use to reach out to your stakeholders. Right? Quickly take down these stakeholders, list of stakeholders. You can also add much more, but let us confine to this list. Suppose if in exams, if you are asked to write 5-6 stakeholders, you need to know. Okay, so you can think about it in another way also. Now last week we learned users of financial information. Users of financial information. So users of financial information is also the stakeholders of the company, right? Users of the financial information is also the stakeholders of the company. So you can think about it in that manner also, right? Okay, so now the question is, now you have 3 or 4 banks in the market. Bank A, Bank B, Bank C, Bank D. So I might always take an example of a bank to make it very simple, right? Because your examination is also mostly evolving around bank or the banking business, right? So I will also take the examples of relating to the banks rather than looking at the normal companies. Okay, right. Now let's say there are 4 banks. There are 4 banks. These are the stakeholders of all 4 banks, right? Every bank, there will be a stakeholder. So each and every bank will try to now reach out to these stakeholders by way of the financial information pertaining to their each and every company. Now let us assume, right? This person produces financial in a different manner. This person is in a different manner. This person is a different manner. All 4 are producing financial information in totally different ways, right? You can't like compare one with the other. Now, if you are a stakeholder and you want to make a choice out of these 4, can you make it? Are you in a position to make it?
No.
No. Why? Because
Can't
I
compare.
will be totally confused. I will be totally confused. If everyone is preparing financial information in their own way. They are giving information in various ways, which I don't understand. So as a stakeholder, I want some uniformity. Do you understand that? There should be some uniformity so that if everyone prepares financial information in a certain way, then it is easy for me to make a judgment. Do you all understand that? Why this information, financial information is very important and why it needs to be uniform without everyone doing in their own way where people are confused to make a decision. Right? So how do we make this uniform? How do we make this uniform? Now today, you know, everyone is fighting against a pandemic. Fighting against a pandemic. Right. Now if the government says, look, people, everybody stay at home, don't come out. Will that happen? Will that happen? It won't happen. People might not listen. But the moment you say that, here, look, everything is locked down, you can't come out. There will be no transport. You can't travel inter-province. What happens now? Everybody is confined to the law. Confined to the law now. Initially, it was just an announcement. Don't come out. People don't listen. They go out and the disease gets spread. But now here comes an instruction, a law, a rule, where you can't go out. If you go, you will be punished. So, if the regulating body says, look, you must prepare your accounts in one particular manner. You can't do it in your own way. If it is an open statement, then you don't know whether everybody will confine to that. But now what we have to do? We have to bring them all into one particular structure. One particular structure. That is where you need a framework. You need a framework. Okay, so I am trying like my level best to introduce the terms, right, little by little, so that you are not confused or bored with the terms that initially if you start bringing in all the complicated terms, right? Okay. I hope you would have taken down on the what is on the board. Right. So we are looking at why you need a common framework. So now you would have understood why you need a common framework. Right. So accounting is considered as a communication method or a communication tool. I told you that is the most common tool that we people make use to communicate. So when these stakeholders or the users, they want to make economic decisions. They want to make economic decision. Now we said earlier why they want to use this financial information, because they are interested in your company. Why they are interested? Because they want to make economic decisions. We call them as economic decisions. Very important term. If you have the note, please underline. Now, economic decisions means where you will make a decision which is very profitable to you or very advantageous to you, and a decision that you make in terms of monetary value, right? Economic decision will be end of the day where you will make a decision regarding this entity or a company, where it ends up profitable to you or you make an adequate return to you. The return could be anything, but you should be in a position to measure it. you should be in a position to measure it. So that is what economic decision will be. So in order to achieve this objective, you need the financial information or the financial statement to be uniform. You want the financial statements or the information should be uniform, as I told you. But now it is not only uniform, it has to be very quality information. Very quality information. And also it needs to be very reliable. Reliability is very important. Now when somebody is publishing financial information, you should be confident to make use of it. That is what reliability is. Reliability means where you can depend on this financial information, right? So where you can depend on the financial information and you can make a decision. But if somebody is giving a bogus information, right? Now say sometimes all of a sudden there is a fake news coming up saying that there is curfew from 6 onwards, 6 p.m. onwards. What do? We will try to find out whether it is from a reliable source, aren't we? We try to establish the accuracy of this information. So we will look at whether this is from a news channel or this is from the government publication to establish whether this information is reliable. Or you might switch on the TV to see whether there is a speech going on by somebody informing this there is a curfew. So there, like, you will try to establish this information to see whether it is accurate. So the accuracy comes from the quality and the reliability that they provide. So like similarly, for financial information also, you need to have the quality, the reliability, and the uniformity. Okay. Sometimes you might be asked, what are the most important or valuable characteristics of financial statements? So you have to say that it should be in good quality, it should be reliable, and it should be uniform. It should be uniform. Right. So I have been talking about a framework. Now what is this framework is? We call it as a conceptual framework. So conceptual framework is a group of concepts which we will learn next week probably, that helps to prepare and present financial statements. So your financial statements of your organization are prepared based on a set of concepts. Now these concepts are actually, we can call it as rules or the basis or the fundamentals of how you prepare your financial statements. Okay, we will learn that what is a concept is. It also helps to evaluate the accounting process. Now accounting process is also there, we will learn. So whether your accounting process happens correctly will be evaluated through this conceptual framework. And the main objectives of this framework would be to understand and explain the current accounting procedure and justifying the reasons for selecting some. Now during our course, we will learn a lot of concepts, we will learn a lot of standards, accounting standards which will govern or which will regulate all these concepts and the framework. And it also explains how your future accounting procedure should be. Very importantly, you will come to know the important terms in accounting standards and their limitations whether you can use it, or if you are to use it, how, to what extent you can use it. All those will be known to you by way of the conceptual framework. So when you are preparing financial statements, we also apply certain assumptions. Now, when you do maybe in your O levels, maybe sometimes in your A levels, when you are doing certain questions, you might have to make certain assumptions. You might have to make certain assumptions. Now, in accounting also, we need to do that. We need to do that because sometimes we are compelled to do it. You need to make an assumption and then only you can proceed with the accounting structure or the accounting practice. Now, remember, in your examination, you can't be doing assumptions or you can't make assumptions and answer your question unless it is required by the question. Unless it is required by the question itself. Right. So, the most important assumption that we are going to learn, you can call it also a concept also, is the accrual basis. The accrual basis. Please remember that term because it is going to come over and over again. Over and over again. Now, what do you mean by this? What do you mean by this? It says the effects of transactions and other events are recognized when they occur rather than when cash or its equivalent is received or paid. Right? Whether you like it or not, you might have to memorize this. Sometimes you might be asked to write what is accrual basis is. But for our course, we need to know what does this accrual basis do. What does this accrual basis do? That is what is very important, right? Now we need to understand that first. We need to understand that first, right? Now let us take an example today. Today is July 10th, right? Right. Let's assume that this is a working day. So there is a customer who is coming to you, a depositor. He wants to deposit 10 million. He wants to deposit 10 million with your bank in a deposit. And you agree to pay him 10% per annum. What is this? This is the interest rate. So you agree to this customer that you will pay 10% per year. Per annum means per year. Right? You will pay 10% per annum. And he wants to keep this deposit in a fixed deposit for 5 years. For 5 years. Right? Can we quickly calculate how much of interest should we pay? Can we quickly calculate how much of interest should we pay? Quickly. How much is the interest that you will pay to this customer at the end of 5 years? Yes, very straightforward. You need to pay 5 million. 5 million is the interest. Okay, you can put it as a message or a chat in the portal. You don't need to speak out also. Right. So what does it mean? We are in time equals 0. That is now. Right. So you will reach T equal 5. That is after 5 years. So after 5 years means you will reach, when you reach July 10, 2026. 2026. Right? When you reach July 10, 2026, what is going to happen? This depositor or the customer will come to you and you will have to pay rupees 10 million plus rupees 5 million. Right? What do you call this? This is capital. This is interest. Okay. So this is the amount that you need to pay after 5 years from now. So during this time period, you will go through 5 time periods. 5 time periods. You will complete 1 year, 2 years, 3 years, 4 years, and then 5 years. Okay. So, as a bank, you can't wait till the 5 years is over to look at this payment of 5 million. You can't look at payment of this 5 million after 5 years. That is not permitted. According to the framework of accounting, you have to think about making this payment after 5 years, but from today. From today, right? Now you are going to tell me, let's say, how many months are there in between? How many months are there in between? During this 5-year period, there will be 60 months. There will be 60 months, right? 12 months each, you will have 60 months, right? In this time period, you will have 12, 12, 12. If you are preparing financial statements on a monthly basis, right? So you will have 12 months in between. Okay. Let's assume that you are making yearly financial statements. So what you need to do is, at the end of the first year, now remember, this 5 million is known as a expense. For the bank, it is an expense. Now, we will learn it shortly. For the bank, it is an expense. It is an expense. So, the bank can't wait till 5 years to incur this expense. They have to think about it today. When the time is 0, they have to think about it. So what they will do is, from day 1, they will start allocating this 5 million. By the end of the first year, you would have allocated 1 million. When you reach the second year, you have allocated 2 million. When you reach the third year, 3 million. Fourth year, 4 million. And then the fifth year, you will have the final. So what you are going to do, you are going to absorb an interest expense every year. 1 million, then the second 1 million, third 1 million, fourth 1 million, and the fifth 1 million. At the end, when the customer comes, you need to pay 15 million. You need to pay 15 million. So what happens? Today, customer gave you 10 million cash, received cash. And what is going to happen here? you need to pay cash. So the receipt of cash and the payment of cash happens at time equal 0 and time equal 5. But what do you mean by accrual? What do you mean by accrual? I am not bothered about receiving cash or paying cash. What is important is in between what is going to happen. I am going to recognize an expense or a cost every year, 1 million each over the next 5 years. This mechanism of allocating my income or expense, it could be an income or it could be an expense. Recognition of income or expense, like on this basis, irrespective of whether you received cash or you paid cash. That is known accrual basis. Do you all understand that? Is that clear with you all? Because you need to understand this very clearly. This concept is very, very important. The accrual basis concept. Right. So once again, I'll repeat it. We are assuming a deposit of for 5 years from a customer, where the customer gives you 10 million today, so you receive cash of 10 million. According to the contract, 10 million deposited today for 5 years at 10% per annum. So assuming a simple interest calculation, at the end of the 5-year period, you will have to pay 5 million, along with the 10 million the customer gave. So 10 plus 5, you have to pay 15 million. According to the whole transaction, the contract gives you 10 million in cash today, and after 5 years, you have to pay 15 million in cash. So receipt of cash and payment of cash happens only at the end of the 2 legs. But in between, what does the bank has to do? The bank can't wait till 5 years is over to pay this 5 million. Now itself, they have to set aside an amount. Set aside an amount. This is like a saving money, right? Now the customer is not in a position to save money, so he is coming to the bank. So what does the bank do? You receive 10 million today, you will make use of it. The bank will make use of this 10 million. So out of the 10 million, whatever the profit that you make, you will allocate 1 million to this person. First year 1 million, second year 1 million, third year 1 million, fourth year 1 million, fifth year 1 million. By the end of the 5th year, I need to pay this 10 million and the 5 million I allocated for this customer, and 15 million will go up. Now, what do you mean by accrual concept is not what you receive in cash or not what you pay in cash, what you account for during this period. This mechanism is known as accrual basis. That is where you recognize an income or expense. Now here I am talking about a deposit because it is very easy. Similarly, you can have a loan where the customer will have to pay, right? So here, whether it is an income or an expense, it doesn't matter, right? What we want is we have to account for the income or expense irrespective of whether the cash is received or cash is paid. Cash is received or cash is paid, right? So I'll give you 2 minutes, quickly take down this, and then we have to take down a small note. Quickly write down. Or you can have a photograph or image taken. Below that you can take down. According to the above example, the bank is required to set aside an interest expense of 5 million over a period of 5 years. This is done without any consideration of receipt or payment of cash. This mechanism of allocating interest expense or any other expense is known as accrual basis. Right? So, if you really look at it, you can put it like this also. Now, this we looked at in terms of a deposit and how you will allocate interest. Now, let's take you are a person looking at your own expenses every month. Okay, you are looking at your own expenses on a monthly basis, and you allocate your salary accordingly. Right. Now we are in the month of, let's say, this is April, June, May, June, and July. Right. Right. So you allocate your expenses accordingly based on your salary. Now say every month you are supposed to pay your mobile bill. Right. So in the month of April you get 550 rupees. Now mobile bill is very costly now. So let's say 550. And in May you get somewhere around 750 because of the lockdown that and this has gone up. And June 600. Right? Like this. So what happens now? Of course, with the technology, we have so many ways of doing it. But in April, you get this bill. Let's assume you get this information. 550 is there. So you allocate the 550. But in May, you don't get this. You don't get this. Right? But just because you didn't get this bill, it doesn't mean it is not going to be any charge. Yeah, definitely there will be a charge because you have used the mobile phone. So what you need to do is, whether you receive the bill or not, you have to pay this amount or somewhat similar to this amount. Need not be the exact amount, but somewhat similar to the amount to keep your connection running. Otherwise, the very next month they might disconnect. So, what is happening here? Irrespective of whether I get the bill or not, I am trying to allocate this sum or a sum similar to this. That is the approach of accrual basis. So we make use of this accrual basis when we prepare and when we go on further, you will say this accrual basis is used to make provisions. We introduce a term called provisions. We make income provisions and expense provisions in terms of accrual basis. So whether you receive in cash or not, you make a provision, and that will be on accrual basis. Irrespective of whether you pay or not, you make a provision on accrual basis. Okay, right. So next line you write, accordingly, companies may be required to make provisions. Companies may be required to make provisions for income or expenses. On accrual basis, whether sorry, before you that you have to say irrespective of whether they receive or pay, cash. Right? So that is about accrual basis. Right. We'll go to the next concept, going concern. So going concern is where the financial statements of a company is prepared on the basis of that the company will continue in operation. And that is for an indefinite period. What do you mean by that is, why you are making or preparing financial statements is that we are assuming we are assuming that the company will run forever. We are not expecting that the company will be closed down in 5 months down the line, or maybe 12 months down the line. We never prepare financial statements with that intention. With that intention. We always prepare financial statements thinking that the company will run for another 10 years, 15 years, 20 years. We don't know. That is why it is indefinite. So, you should never prepare financial statements on the basis of where the companies will be closed down. Hence, you need to prepare financial statements on the basis of that the companies are indefinite. Indefinite. Please underline that, indefinite. Right. So I have already touched upon little bit on this already, where we spoke about how the financial information should be. It has to be reliable, it has to be uniform, it has to be very quality. So all those are there. But now we are going to look at certain other characteristics of financial statements where we call them as qualitative characteristics. Qualitative means features. Quantitative means numbers. Right? So what we are looking at is qualitative features. Qualitative characteristics of financial statement. So the first one is, as you know, we say that it has to be understandable. Understandable. So it is the understandability is the first right? So the financial statement should be understandable. Understandable. So it says information should be presented in a way that is readily understandable by users who have a reasonable knowledge of business and economic activities and accounting. Right? So it means that you have to present the financial information to the users or your stakeholders in a very understandable manner, where they can easily understand the financial information that you are providing. Secondly, it says relevance. Relevance. The second characteristic is relevance. So information in a financial statement should be relevant, because it is going to impact the decisions made by the users. Decisions made by the users, which is very important, right? So the financial information that you are providing or the financial statements that you are presenting should be relevant so that it can have an influence or an impact on the decisions made by the users. Okay? If you are not providing relevant information, then they will not consider at all. They will just ignore it. They will just ignore it. Third one, as I told you, I have already discussed this, it has to be reliable. It has to be reliable. So the financial statement has to be provided by a reliable person of your organization, namely the chief financial officer or the managing director, whoever is from a reliable person, and you can depend on that. You can depend on the financial information. And lastly, it has to be comparable. it has to be comparable. So this feature is very, very important. You can recall the example that I showed you where there are 4 banks, A, B, C, D, and if everyone is trying to produce the financial statement in their own way, there is no comparability because you can't make a choice. So it is very important that the financial statements that you prepare or the financial information that you provide should reflect where it can be comparable, right? So we have come to a point where now we have looked at 4 important characteristics. 4 important characteristics. What are those? One is the understandability. Second one is the relevance. Third one is the reliability, and the fourth one is the comparability, right? When it comes to the comparability, please note the comparability can take 2 forms. One is where you should be able to compare your results with your own results. With your own results. What do you mean by that is, now you know the financial information are provided on a yearly basis. Generally, that is what companies will do to the outsiders. But within the organization, they will do it on a monthly or maybe quarterly or whatever. They can do it of their choice. But generally for outsiders, they do it once in every year. So what does it mean? Every year you are evaluating your performance. So the financial statements that you prepare should reflect what you are doing currently or what you did currently and what was your performance in the last year, right? So it has to be comparable even with your own performance. Say for example, what the company did in 2020 and how much is the profit against the profit that they have earned in 2019. So that is one sort of a comparison. The second type of comparison is where you compare your this year performance along with the performance of other companies. Right? In that early example, you compare bank A with bank B. That is another type of comparison. So comparisons can be of 2 types. One is with your own performance and the other one is with another entity or competitor. Right. Now we come to the most important elements of the financial statements. Right. So what I have done is here, I have put down each and every element of the financial statement and where it gets reported, right? And the terms that I have used, some of you might have already know, but for some of you all might be very new to this, right? The traditional names that we used for financial statements, namely the P&L and the balance sheet. But now we don't use those names. The name P&L and the name balance sheet are not heard or not really used. So instead of that, now we have some new terms replacing those old terminologies. Right. Now let's look at it. Okay. So what are we saying? we have elements called assets, liabilities, equity, income, expense, and cash flows. Okay. So when you take these two, or preferably this part of this also, goes into the balance sheet. Right? The name balance sheet is the traditional name that we used. But the new name is statement of financial position. You need to get used to this name. Statement of financial position. The equity component is also reported in the statement of changes in equity. Okay. SOC, statement of changes in equity. Then we have the income and the expense. It goes into the P&L. We can traditionally we call it as the P&L, but now it has a new name. Statement of comprehensive income. Statement of comprehensive income. These short forms, you can use it in the examination, so you have to remember. And the last one, cash flows. We call it as is going to the statement of cash flows. So this is SOC, statement of cash flows. Right? You can make a note in your handout. Right? So what is the take home for us? Right? In your examination, I don't know how many of you have seen your exam paper. Better if you can have a look at any of these exam papers if you have access. Right? If you look at your examination paper, this is your question 1. Right? Your question 1 of your examination paper is this. Preparation of a statement of financial position, statement of changes in equity, statement of comprehensive income. And mind you, this question 1 is compulsory. There is no choice for you. You need to answer it. Right? So it's a compulsory question. Question number 1 is compulsory to you. But statement of cash flows is an optional. Question. Right? So generally, this could be tested or may not be tested. But this is given. This is a must. This is optional. It might come in the paper or might not come. But what I have seen is in the recent past, this is being tested. So most importantly, when you look at the structure of your examination, all our learnings, whatever that we are going to learn in the next 4 to 5 months, will be ultimately landing in these two. Landing in these two. So you have to make yourself prepared for that. Our objective is to ensure towards the end of this course, we need to know how do we prepare these two sets of financial, actually 4 sets of financial statements, and how do we interpret them? How do we interpret them? Thereby, when you go back to your organizations, you will have a good knowledge about how to evaluate your customer. How to evaluate your customer, because your customer evaluation will definitely depend on evaluating their financial statements. Evaluating their financial statements. Is that clear? Any questions? Do you have any questions? Okay. Right. Then I think I have given some definitions. These definitions are might be required because in one examination it was tested. In one of the examinations it was tested to write a brief description about assets, liabilities, and they also asked for about equity. Okay, so you need to know the theoretical definitions of these. So what do they say as assets? An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. So this definition looks little bit complex, or maybe you might not get it very clear also, but this is the theoretical definition. So whether you like it or not, you need to know this. But let me put this in simple form. What are assets, right? An asset, now you know what is resources. Resource is anything that is available to you is a resource. Say water. Water is a resource, right? But what happens, resources are very scarce or very limited. So that's why we say that you need to use them very carefully. Use them very carefully. If you look at it, in some of the countries now they are facing a difficulty or a crisis where they might not have water, right? They might not have water to use, drink or whatever. So sometimes they might have to go and borrow from somebody else. Borrow from somebody else. Okay, right? Not in Sri Lanka definitely right now, but in time to come we don't know. Anything can happen. So a resource is something that is available for you to use. But why you call it as an asset is, now this resource is going to be controlled by your company. Resource is going to be controlled by your company. So why that asset or the resource is going to be controlled by your company is because it was a result of a past event. Now why there is an asset? Because there was some event that took place previously. As a result, now you have an asset. And the objective is that you are going to get some benefit out of this asset in the future. Now let's take an example. Let's take you have a computer in your organization. Now this computer is a resource for you. And who is the owner of the asset? It is your company. So they are going to control it. Why did you have this asset now? Because at some earlier point, your company decided to buy a new computer. That is the past event, a decision to buy a computer. So now you have an asset which came from a past event, but what are we looking at it? Now this asset will have to give you benefits in the future. Of course, you are going to use that computer in your business to prepare accounts or maybe generate your invoices. You can use that computer for various purposes. Now that is going to be the economic benefit that you are going to get out of this asset. So it is very important that you know what is an asset is. Okay. Then we go to liabilities. Liabilities say it is an essential characteristic of a liability is that the entity has a present obligation. So you know obligation. What is obligation? Something that you have to perform. Something that you have to perform. Obligation may be legally enforceable as a consequence of binding contract or statutory requirement. So when your company is functioning, there could be a situation where you have an obligation every other time. Say for example, your company is using electricity. So there is an obligation on your part. You need to pay to the electricity board for your electricity consumption. That is a liability of yours or an obligation. Then we have, before coming to expense and income, I'm going to the equity. Equity is actually known as the residual value of assets and liabilities, right? So it is very straightforward. I will explain in detail what it means. But before that, you have income and expenses. So I have already explained what is income and what is expense. Expense is anything that encompasses a loss as well as those expenses that arise in the ordinary activities of the business. So businesses might have to incur several expenses to meet up your business income, right? But income is something that you receive. Expense is something that you pay, right? But expense is something that you pay for your consumption, not to purchase, right? When you purchase, it will become an asset. Income is something that you receive as a result of your business, Right. Now, when it comes to equity, what do they say? Equity is known as the residual value. The residual value, very important. This is going to be the heart and soul of all our learning. Because that is what very important, because we are going to start our first step in this course by looking at this very important concept. So what do they say? Equity is equal to assets minus liabilities. Right? Now they say it is the residual. Now this residual means assets minus liability, there should be a difference. that difference is known as equity. So generally you expect this to have a number and it has to be greater than 0. Greater than 0. Generally what do you say? Assets minus liability, there should be a number and that number should be greater than 0. When it happens, that is what equity is. That is what equity is. So what is the important thing is, this is the most important formula that you are going to learn today. And this has to be followed at every learning of yours during this course. This is the fundamental basis for all our future learning. The definition of equity is going to help us throughout in this course. And from this definition, what do? We derive this equation. That is, assets equals liabilities plus equity. Very important derivation. Assets equals liabilities plus equity. Assets equals liabilities plus equity. Please take down. Okay. Right. So the next slide is actually, I'm going to skip it because it's just a background on how this concept of accounting was born. Right. So we know that Mr. Luca Pacioli is known as the father of accounting. Right. He has published several books which talks about the concept of accounting and related mathematics and everything. Right. Okay. So now we come to the fundamental of accounting, which is known as the accounting equation. So what I introduced a short while ago on the board is known as the accounting equation. The accounting equation. That is going to be the foundation of double entry accounting. Double entry account, because we have to follow the double entry principle throughout this course. In order to establish all our workings, calculations, and preparing financial statements, all will depend on the double entry principle. Double entry principle. So, which is actually coming from the formula that we derived now. That is, assets equals liabilities plus equity. Liabilities plus equity. Right? So this is the formula. We know, we call it as accounting equation. Then I have given some examples, right? What are known as assets, what are known as liabilities, and what are known as equity. What are known as equity. Okay, right. Now we look at the expanded accounting equation. Expanded accounting equation. So we know now assets equals liabilities plus equity. But what do we mean by equity in a company? What do we mean by equity in a company? You would have already seen in the table. Now, when you look at equity of a company, as I told you, it has capital, right? It also has profit, the profit or the loss that the company will make. Profit or loss the company will make. And there is another term which I am going to introduce now called reserves. Right? We will learn gradually what the reserves are. And most importantly, the next part, what you distribute to your shareholders, the dividends. Okay? Dividends. Right. So what happens in the equity, this is a positive, this is a positive, this is a negative, this is a positive or a negative, and this is a negative. Right? This is a negative. So capital means always a positive thing to the organization because that is how the company is being run. But using this capital, what will happen? The company will make a profit or it could end up in a loss. Positive profit means it's a positive thing, loss means it's a negative. While running the business, there could be other reserves created, which is again belongs to the shareholders. So all of these belongs to the shareholders. Reserves, there could be positive reserves or there could be negative reserves. But end of the day, when you make a profit, it is your responsibility to pay a dividend. So the payment of dividend that you make is a negative. So all these are included within this, right? So what I am going to do now is, as you know, I am going to take this equity component now and write it like capital plus profit stroke loss, right? And let's keep it very simple. It will be dividends. Okay. Now the component of profit or loss means it is the result of income minus expenses, right? So this is the positive, this is the negative, right? Income minus expenses. Income is whatever that you receive, expense is whatever that you pay. So as a result, now the expanded accounting equation will be assets equals liabilities plus capital plus income minus expenses minus dividend. So when you do that, this becomes your expanded accounting equation. In addition to that, you can bring in reserves also, but I'm not going to write it now. So this expanded accounting equation can be tested in your examination in any way. They can take the income onto one side, or they can take the income and expense onto one side, put the other things into the other side. So you should know the combinations that are possible. So I think it's already there on the presentation. Right, it's already there. Okay. Now I'm going to introduce another terminology. So you know that income minus expense is your profit, and from the profit you pay a dividend, right? Once you pay that, the result of all three, income minus expense minus dividend, is known as your retained profits or retained earnings. Okay, these two terms are very important. Retained profits or retained earnings, both are same, but you should know, because going further, when I say retained profits, you should know what it is. Retained profit means your income minus expense minus any dividends that you are required to pay, right? If the dividends are zero, then it is income minus expense. Okay, so it is very important that you should know what is the expanded accounting equation is and how you can interpret it or maybe interchangeably use it, and also how this retained profit is calculated. Retained profit is calculated. Right. So we have the accounting equation, and then you get the equity, which is capital plus revenue. Revenue means another name for income, right? Income can be also known as revenues. And this is profit or loss, revenue minus expense. And revenue minus expense minus dividend is known as retained earnings. Retained earnings. Any questions? Any questions up to now? Okay. So next item that we are going to look at is how the financial statements could be measured. That is, these items that we discuss now, asset, liability, income, expense, equity, dividend, everything has to be measured. Now, how do we measure it in terms of rupees and cents? Rupees and cents. That is what we are going to look at. And this will be based on certain concepts or features that we are going to learn now. So there is a terminology called historical cost. Historical cost. Then there is something called current cost. Then you get the realizable value and the present value, right? Sorry. Now there are four values: historical cost, current cost, realizable value, and the present value. Present value, right? So what are these? Right? So please try to understand this carefully, because these are going to be used heavily on our course. First one is historical cost. Historical cost, current cost, and realizable value. Right. Now I am going to take an example. let's take a television, right? There is a television. Now you want to buy a television, latest model television today, right? So what would be the price? Let's say 200,000, just for argument's sake, 200,000. Now today, this is 2021. 2021. Now, if you had purchased this TV in let's say 2000, without going a very old period, let's take 2000. That is about 20 years ago. What would have been the cost? Just an estimate. Let's say it's about 80,000. About 80,000. Okay. Now you are in 2021. So you want to get rid of this TV and you want to buy this. So you have decided now to sell this. To sell this. What is the value that you expect when you sell this? Let's say you get, it is very unlikely, you get 15,000. You get 15,000. Okay. Right? So what if you buy a TV after another 5 years? Let's say 2025. So let's say the TV will be 300,000. I'm talking about the same similar TV with different features without differentiating the TVs. So I'm trying to make it in a nutshell, this whole example. What if I buy it in another 5 years time? Right? Now let's try to understand. So I have 4 characteristics on this side, or parameters, and have 4 prices on this side. Right? So I'm like just a grade 1 exercise. I'm going to give you to match these items. Match these items. What is on left with what is on the right. Can you do it quickly? What do you think? What do you think the current cost out of all these values? What is the current cost out of all these, do you think? Yes? What is the value? 200,000. 200,000. So what do you mean by that? Basically, this is the value that you pay now to acquire the asset, isn't it? If you want to buy this asset now, what is the cost or the value that you need to pay is current cost. Is current cost. If the same, what I would have paid in 2000, which is the 80,000, is the historical cost. Historical cost. The cost that I would have paid in the past to acquire that asset. Now we are going into the third one, 15,000, which is the value that could be realized. We say that it is realized. Even though you think that you can sell it for 50,000, the real condition in the market would be people might only want to buy it at 15,000. They will not give you more than that. So the realizable value would be 15,000. Right? The present value is little tricky. Okay? It's not actually this 300,000. It's not actually this 300,000. Okay? Now, suppose if you are thinking about buying a TV in 5 years' time, you estimate the value to be 300,000 in after 5 years' time, that is in 2025. So if I am to buy that TV today, what would be my value? What would be my value? That is called present value. That is called the present value. Therefore, we call this as, the concept of present value is known as the time value of money. Time value of money. Time value of money. That is what present value is. So present value is, I am expecting to get 300,000 after 5 years or 4 years. So getting 300,000 after 4 years is worth how much today? Let's forget about this concept of TV now. Let's say your salary. You are expecting your salary to be 300,000 in 2025. Having 300,000 in 2025, how much is it worth today? That is called present. It's called present. Okay. So any questions on that? Right. So we will stop there, and please do revise all what we have done last week and this week. And there is a homework for you. I want you to find out do some little research and find out the definitions for these four. What is historical cost? What is current cost? What is realizable value? What is present? So you have to find out. You can do a Google, you can do or refer a book, I don't mind, but you need to have this, the definitions of all these four terms in 3 or 4 lines, not more than that. Because in examination, you might be tested to write the definition of these four. Okay, so please do that as homework. It's not really the homework, it is your learning outcome. So you need to find out the definition of these four when you come to next class. Okay, right. So we'll stop there and we will meet up next week. Thank you, and be safe.